Welcome back to the deep dive. And, this is actually a pretty special moment for us.
It really is.
Over 100 deep dives we've done together with you, our listeners.
It's incredible. And the quality of the sources, the complexity,
Yeah,
it really pushes us.
absolutely. We are definitely smarter for wading through these dense, complicated, sometimes really high-stakes stacks you send us. And today is no exception. We're tackling corporate finance meets the wild world of digital assets.
Yeah, it's a fantastic topic because we're not just talking about, crypto as some speculative thing on the side. We're really analyzing a structural shift, a genuine innovation in corporate finance itself.
You mean these digital asset treasury companies, DATs?
Exactly. DATs, these are public companies listed on exchanges,
Yeah.
but they're acting essentially as regulated proxies for holding these, let's face it, often very volatile digital assets.
Okay, so our mission today, based on the sources you've sent in, is really to dissect the strategies of the big players here. We've got Strategy Inc., MSTR,
Fine.
right. Then Bitmine Immersion, BMNR, Eightco Holdings, ORBS, and then there's Block XYZ, Jack Dorsey's company, which seems like a different model altogether.
It is. And we need to figure out, based on the analysis in these sources, which of these approaches to this sort of digital future is strategically sound.
And which one might be, built on shaky ground, or maybe just hype.
Precisely.
Yeah.
And to do that properly, we first have to understand the three core assets these companies are actually leveraging, because they each represent a pretty distinct vision of where things might be headed.
Okay, lay them out for us.
So first you've got Bitcoin, BTC. That's the pure store of value play, right?
Yeah.
The ultimate scarce digital asset, digital gold, as they say.
Makes sense. The original.
And number two, there's Ethereum, ETH. That's positioned more as the foundational layer, the backbone for digital asset ownership in a broader sense.
So that covers things like stablecoins, NFTs, maybe these real-world assets, RWAs that people talk about.
Exactly. The infrastructure for owning and trading other digital things. And then the third one.
This is the interesting one, the real forward-looking bit, right? Worldcoin.
Yeah, Worldcoin, WLD. This one's different. It's not about value storage or financial infrastructure in the same way. It's an attempt, maybe a controversial one, at creating proof of personhood.
Proof of personhood, meaning verifying that you're a unique human being online.
Exactly. Using things like iris scans, the idea being in an age of, increasingly sophisticated AI and deepfakes, being able to cryptographically prove you're human could become incredibly valuable, maybe essential.
Wow. Okay, so scarcity with Bitcoin, infrastructure with Ethereum, and identity with Worldcoin. Three very different bets.
Three corporate strategies built around those three distinct concepts. It's a fascinating setup.
All right, this is definitely high-stakes stuff. Let's unpack this convergence of corporate strategy, finance, and, the future of the internet, I suppose. So let's start at the beginning. This whole DAT model, we need to get the basic mechanics clear. What exactly is a digital asset treasury company, and how did it just sort of explode onto the corporate finance scene so fast?
Okay, so a DAT, at its core, is an innovation where a public company makes a formal, explicit decision. They adopt a specific digital asset, typically Bitcoin or Ethereum, but now others too, as a primary core part of their treasury reserves.
So it's not just like dabbling, not just a small investment on the side.
No, it's an institutional commitment. It's central to their strategy and balance sheet. And the clever part, or the innovative part, is how they fund it. These companies go out and raise capital, they issue stock, their own equity, or often they use debt instruments like convertible bonds.
Okay, they raise regular money, fiat currency.
Right, and then they take that capital and systematically, programmatically convert it into their chosen cryptocurrency.
Yeah.
Bitcoin, ETH, whatever it is. They just keep buying.
Okay, I get the mechanics. But here's the question. If I'm an average investor, why wouldn't I just, download Coinbase or Kraken and buy Bitcoin directly? Why pay a premium, potentially, to buy the stock of a company that just holds Bitcoin? What's the value proposition? What are they selling?
That's the crucial question. What they are selling, fundamentally, is access and convenience. They are monetizing the friction, the hassle that still exists for many people when it comes to owning crypto directly.
Friction like what? Managing private keys? Wallet?
Exactly.
Yep.
Think about institutional investors or maybe older retail investors. They might be uncomfortable or unfamiliar with managing private keys, securing cold storage, dealing with exchanges that maybe aren't fully regulated everywhere. It's complex. It feels risky from an operational security standpoint.
Okay.
So the D does that for you. It takes this complex, novel, often really volatile asset
Like Bitcoin.
and wraps it up inside something very familiar and regulated, a publicly traded stock. A ticker symbol you can buy in your normal brokerage account, your IRA, whatever. It just slots into the existing financial system.
I see. So it's kind of like regulatory arbitrage, or
Uh,
maybe accessibility arbitrage. They're making money by being the easy regulated bridge to this new asset class.
That's an excellent way to put it. Accessibility arbitrage.
Right.
And you can actually measure the value of this bridge by looking at the stock price compared to the actual market value of the crypto the company holds. That underlying value is called the net asset value, or NAV. The DAT stock almost always trades at a premium to its NAV.
Meaning you pay more for the stock than the underlying coins are worth.
Correct. And that premium, whether it's 10%, 20%, sometimes much more, that is the quantifiable measure of how much investors are willing to pay for that convenience, that liquidity, that regulated wrapper. That premium is the deep business model, is what they capture.
Okay, that sounds pretty smart. Lucrative even, but it also sounds inherently fragile.
Critically fragile, yes. This model worked, it thrived because it filled a vacuum. There weren't many easy, regulated ways to get exposure, especially for institutions, but that's changing fast.
You mean because of the spot crypto ETFs, the exchange-traded funds?
Exactly. As low-cost regulated spot crypto ETFs become widely available, especially for Bitcoin and maybe Ethereum, that friction, that hassle of direct ownership, it just melts away from most investors.
So if you can just buy a cheap ETF that directly tracks the price of Bitcoin.
Why would you pay a significant premium for a DAT stock that just holds Bitcoin? The fundamental justification for that premium starts to erode very, very quickly. The commoditization of access, making it cheap and easy for everyone, that's the existential threat hanging over the pure DAT model.
Makes sense. And the company that really established this blueprint, this whole playbook, was Strategy Inc., MSTR, right? Back in 2020. They pivoted from being this like old school enterprise software company.
Yeah, MicroStrategy originally, they completely changed the game. Their pivot wasn't just successful, it was like a financial earthquake. Suddenly, this legacy software company's stock became one of the absolute best performers on Wall Street for a couple of years.
And that success just spawned a whole wave of copycats, didn't it? The sources mentioned over 200 imitators.
Oh, yeah. They created the template. They showed other companies, look, you can capture this massive crypto-hungry investor base simply by redefining your corporate identity around holding Bitcoin. It was incredibly powerful.
And interestingly, the sources also point out that this deep model wasn't just appealing to already successful companies. It actually became a lifeline for firms that were, well, struggling. Slow growth, maybe even losing money.
That's a really crucial piece of context. Absolutely. Imagine you're running a company. Maybe your core business is stagnating. You're posting net losses. You've kind of lost market relevance. Adopting a crypto treasury strategy offers a way to completely reinvent yourself.
How so?
Instantly, you can reinvent the brand. You tap into this incredibly energetic, speculative investor base that's hungry for crypto exposure.
Yeah.
And critically, it allows you to raise significant amounts of new capital, often through stock sales at that premium we talked about, capital that might have been completely unavailable to your old struggling business.
Wow. So for some of these newer DATs, the motivation might be less about a deep belief in the asset and more about, well, raising cash and getting attention, swapping a weak business story for a really strong, high-momentum crypto narrative.
That's definitely a factor you have to consider when evaluating them, especially the newer entrants. The initial driver can often be more about capital formation and securing brand relevance in a hot market than about, say, operational synergy or long-term strategy.
Okay, let's zoom in on the pioneer then.
Yeah.
Strategy Inc., MSTR. This transformation from a, 1989 era business intelligence software firm, formerly MicroStrategy, it seems totally complete now. Their whole identity is Bitcoin.
It's absolute. The name change to Strategy Inc. in mid-2025 was really the final signal, and the scale is just staggering. As of late 2025, your sources put their holdings at, 640,250 Bitcoin.
640,000 Bitcoin.
Yeah, just let that sink in. That single company holds more Bitcoin than many entire countries. They are, by a huge margin, the world's largest corporate holder of BTC.
And that original software business, the one they started with, is it just irrelevant now?
It's basically been relegated to a footnote, financially speaking. The sources say it really only serves two functions now. One, it provides a little bit of operational cash flow, helps cover some corporate overhead.
Okay.
And two, they kind of use it as a platform to, quote, explore innovation in Bitcoin applications. But let's be clear, the main business, the overwhelming focus, is acquiring Bitcoin, financed by selling stock and debt to the public markets.
Right. And this gets us to the heart of their financial strategy. Michael Saylor, their leader, calls it the crypto reactor. It sounds like this incredibly sophisticated, self-reinforcing flywheel. Can you break down how that actually works?
Yeah, the flywheel concept is key to understanding MSTR. It starts with leverage and how the stock price reacts to Bitcoin's price.
Hmm.
Because they hold a significant amount of debt relative to their assets, the stock price tends to move more than Bitcoin's price does.
It's got amplified sensitivity, a higher beta.
Exactly. Analysts estimate its beta to Bitcoin is around 1.7x. So, simplifying a bit, if Bitcoin goes up 10%, MSTR stock might go up, say, 17%. If Bitcoin drops 10%, MSTR might drop 17%. It amplifies the moves.
Okay, so it magnifies the upside, which attracts investors. But the real magic, the flywheel part, is how they use that inflated stock price to buy even more Bitcoin, right?
That's the core mechanism. It's called accretive acquisition. Remember that premium we talked about? MSTR consistently trades at a significant premium to the net asset value, NAV, of its Bitcoin holdings. Your sources had the market cap to NAV ratio, the MNAV, at 1.37 in late 2025.
1.37. So investors are willing to pay $1.37 for every $1 worth of Bitcoin the company actually holds on its books. That extra 37 cents, that's the
Yeah,
premium.
exactly. Now think about what happens when MSTR wants to buy more Bitcoin. They issue new stock, maybe through convertible bonds, and they sell those shares to the public at that market price, which includes the 37% premium. Effectively, they're raising capital, where every dollar raised only costs existing shareholders about 73 cents in underlying Bitcoin value, 200.37. They then take that dollar and go buy a full dollar's worth of Bitcoin in the market,
Wait, say that again? They sell stock at a premium.
meaning they get more cash per share than the Bitcoin backing that share is worth. They then use that cash to buy Bitcoin at the normal market price. So for every dollar of dilution they impose on existing shareholders, they acquire more than a dollar's worth of Bitcoin NAV.
Ah. So the acquisition itself adds value per share, even after accounting for the new shares issued. It's accretive.
Precisely. It's genuinely clever financial engineering. They are literally converting the market's enthusiasm, that premium, directly into more Bitcoin holdings,
And that new Bitcoin increases the total NAV.
which helps support the stock price, bolsters the narrative, makes it easier to raise capital next time, and the flywheel spins again. The stock price isn't just reflecting the current Bitcoin, it's reflecting the expectation that MSTR will keep doing this accretive acquisition loop forever.
Okay, but hang on. We just talked about the threat from spot ETFs. If those ETFs make direct Bitcoin access cheap and easy, shouldn't that 37% premium just vanish? Why hasn't it collapsed already? What stops the flywheel?
That is the billion-dollar question. And it's undeniably the single greatest risk facing MSTR. If that premium disappears, the accretive acquisition engine stops dead. The flywheel breaks.
So what's Saylor's argument against that? How do they defend the premium?
Well, part of it is logistical and philosophical.
Hmm.
Saylor argues that for large institutions wanting significant Bitcoin exposure, MSTR offers operational simplicity, scale, and a corporate structure that an ETF might not match. Think treasury management, accounting, etc. But more profoundly, his argument is rooted in conviction. He frames Bitcoin not as a tradable asset you flip in and out of, but as a long-term, almost philosophical commitment, the ultimate store of value.
So the argument is serious holders won't just jump to an ETF.
That's the pitch. That MSTR provides something more durable, more institutional grade, maybe even more ideologically pure for true believers. Whether the market continues to buy that argument, especially as ETFs mature, is the key uncertainty.
We definitely have to talk about the leader here, Michael Saylor.
Yeah.
The sources describe him as, well, intense, a ruthless, intimidating nerd, but also a mesmerizing speaker.
He's absolutely a unique figure. He combines this deep, almost obsessive intellectual rigor with a powerful, almost evangelistic communication style. And his background really informs his worldview: MIT aeronautics, systems engineering. He even apparently built simulations of Renaissance city-states. He thinks in systems.
So he sees Bitcoin less as tech and more as a perfect system.
Exactly. He sees it as a mathematically perfected system for managing scarce resources on a global scale.
Mm.
His conviction seems absolute.
And his thesis isn't just Bitcoin's going up, it's much bigger than that.
Oh, far bigger. He calls BTC digital gold, yes, the ultimate hedge against inflation. Standard stuff. But then he elevates it. It's the apex property of the human race, the most scarce, desirable asset humanity has ever created. He even talks about it almost mystically as an economic immortality mechanism created by Satoshi Nakamoto.
Economic immortality, wow.
Wow. So for Saylor, Strategy Inc., isn't just a company making a bet, it's the most optimized corporate vehicle he could design for one purpose. Acquire and hold as much of this apex property, this digital gold, as humanly possible, using financial leverage to accelerate the process. It's driven by deep conviction.
Okay, so if MSTR is the OG, the blueprint built on Bitcoin scarcity and that leveraged flywheel, what about the companies that tried to copy the playbook but picked a different asset, like Bitmine Immersion, BMNR, focusing purely on Ethereum?
Right, BMNR is fascinating because it's such a direct, almost aggressive copycat of the MSTR strategy, but swapping out Bitcoin for Ethereum, ETH.
And their ambition was pretty huge, right? The sources mentioned something called the alchemy of 5%.
Astonishingly ambitious. Their stated goal was to acquire 5% of the entire circulating supply of Ethereum, and they moved incredibly fast. The sources say they amassed something like 3.24 million ETH in just a few weeks. That's nearly 3% of all ETH out there, bought up in a flash.
Whoa, that kind of speed must have generated a ton of hype. But the financial numbers for BMNR, they seem completely detached from reality. The sources talk about an extreme valuation disconnect.
This putting it mildly. This is where BMNR becomes truly extraordinary, or maybe worrying. The sources indicate its stock trades at a price to book, or PB ratio, approaching 5,000 times.
5,000x.
Yes, 5,000x. Just let that number hang there for a second. For comparison, the average PB for the software industry is usually around 4x. Maybe their closest peers, other tech or crypto-related firms might trade around, say, 13x or 14x book value. BMNR is at 5,000.
That's not just exceptional optimism, as the source politely puts it. That sounds like pure fantasy. How can a company, especially one with a history of consistent net losses, according to the sources, possibly sustain a valuation like that?
It tells you everything about who is trading this stock and why. That combination, terrible fundamentals, consistent losses, yet a PB ratio in the stratosphere means it's not being valued by traditional long-term investors looking at the underlying business.
Yeah.
It just can't be.
So who is trading it?
It's driven by momentum. The sources highlight its extremely high daily trading volume, often billions of dollars changing hands, sometimes more than giant, stable blue-chip companies. This is the playground of high-frequency traders, algorithmic systems, and pure speculators chasing the narrative, chasing the price action itself. It's become a high-velocity trading vehicle, almost detached from the company itself.
And that narrative, the story fueling the speculation, is largely driven by their chairman, Tom Lee. He's a pretty well-known Wall Street strategist, right? His name lends credibility.
Absolutely. Having someone like Tom Lee, with his established reputation from traditional finance as chairman, is crucial for BMNR. It helps lend an air of legitimacy to what is fundamentally an incredibly speculative play. And he paints a grand vision for Ethereum.
What's his core thesis?
Lee talks about a 10 to 15-year supercycle for ETH. He argues Ethereum is going to become the new Wall Street, the foundational layer for everything from tokenized real-world assets to the machine-to-machine AI economy, even managing these proof-of-human identity systems.
So ETH as the base layer for the future global economy, basically.
That's the pitch. And based on this, he was forecasting year-term ETH prices of $10,000, maybe $12,000. It's a huge infrastructure-level bet.
Okay, that sounds impressive, visionary even. But the sources we have include some very sharp, data-driven critiques that seem to completely undercut that narrative. What's the counterargument?
The main critique, and it's a powerful one, focuses on what the sources call flawed value accrual. Lee's argument is, as more assets like stablecoins and RWAs move on to Ethereum, the demand for ETH, the token itself, will soar, driving up its price, because ETH is needed for transaction fees, gas, and staking.
Seems logical on the surface. More activity, more demand for the network's native token.
Right, but the critics point out a huge flaw in that logic. Most of the actual transaction volume, the sheer number of transactions related to stablecoins, NFTs, DeFi, etc., isn't actually happening directly on the main Ethereum blockchain anymore. It's migrated to Layer 2 scaling solutions.
Layer 2s like Arbitrum, Optimism, Polygon, those kinds of networks.
Exactly. We need to pause on this because it's critical. Think of the main Ethereum network, Layer 1, as a super secure but very expensive and sometimes congested highway. Layer 2s are like fast, cheap local roads built on top. They handle millions of transactions quickly and cheaply off the main chain. Then, periodically, they bundle up the result of all those transactions and settle them back onto the main Ethereum Layer 1 in a single, much cheaper batch transaction.
I see. So the bulk of the activity, the user interactions, are happening on these Layer 2s.
Precisely. Now remember how ETH is supposed to gain value. Since Ethereum implemented changes like EIP 1559, transaction fees are partly burned, meaning ETH is removed from circulation, making the remaining ETH scarcer and thus more valuable if the base layer is heavily used.
Ah, but if most transactions are happening on layer 2,
Then the main layer 1 isn't generating nearly as many transaction fees. The demand for ETH block space on layer 1 isn't growing proportionally to the overall ecosystem activity. So less ETH gets burned than the narrative might suggest.
so the economic benefit, the value capture, isn't flowing back to ETH holders on the base layer as directly as the BMNR thesis implies. It's maybe staying within the layer 2 ecosystems or accruing to their own tokens.
That's exactly the critique. The critics in our sources basically call the BMNR thesis financially illiterate on this point. They argue the comparison Lee makes that ETH's potential market cap is like the combined value of all global financial infrastructure is pure delusion, cooked up solely to justify that insane 5,000x PB valuation.
Wow, okay. So if that critique is right, then investing in BMNR isn't really a bet on Ethereum's utility. It's purely a bet on the narrative continuing, despite the data.
That's the inescapable conclusion from these sources. It's a high-stakes gamble that this fragile, potentially flawed narrative persists. The primary risk isn't just ETH's price falling, it's a catastrophic narrative failure.
Meaning the market just stops believing the story.
Exactly. If data like the Layer 2 transaction shift becomes widely accepted, or if regulatory scrutiny increases, or if Tom Lee simply loses credibility, that 5,000x multiple has nothing holding it up. The stock could collapse almost instantly towards its very low underlying fundamental value. It's pure sentiment risk.
All right, moving on to the third variant in this DAT space, Eightco Holdings, ORBS. This one feels different again. They've completely detached from Bitcoin's scarcity or Ethereum's infrastructure play. Their whole focus is on Worldcoin, WLD, and this concept of proof of human, POH.
Yeah, ORBS represents a fascinating pivot. It's arguably the first DAT company explicitly positioning itself for the age of AI. They've transformed themselves into the world's first dedicated WLD treasury company.
And their core thesis is all about identity verification.
It is. The argument goes like this. As generative AI gets better and better, the internet is going to be flooded with synthetic content, deepfakes, bots pretending to be human. In that environment, the ability to cryptographically prove that you are a unique, real human being online shifts from a novelty to an essential service.
And Worldcoin's mechanism for that is the orb, the device that scans your iris biometrically to confirm you haven't registered before.
That's the core technology, yes. The iris scan provides the proof of uniqueness. So ORBS is positioning itself to be critical infrastructure for this future, betting that verified human identity will be a massive market.
And they have an ambitious goal tied to this, something about the number 8.
They do. It's called the power of 8. The stated mission is twofold. Acquire 800 million WLD tokens for their treasury and support the infrastructure needed to eventually verify 8 billion humans globally.
8 billion, so essentially the entire planet. The
That's
share just doesn't quite cover it.
It's planetary scale ambition, yes.
Okay, but thinking about ORBS financially, this feels less like MSTR holding a recognized asset like Bitcoin and more like, well, like a publicly traded venture capital fund that's placed a single massive bet on one highly speculative startup, which is Worldcoin itself.
That's a very insightful way to frame it, and I think the sources support that view. It's a crucial distinction. MSTR hold Bitcoin, an asset with a decade-plus history, established value, and relatively understood properties. ORBS holds WLD, the token of a protocol, Worldcoin, that is still very much in its early stages. It hasn't achieved mass adoption, faces significant regulatory questions, and its core utility proposition is still largely theoretical.
And does its valuation reflect that VC-like bet?
Absolutely. The sources indicate ORBS trades at a price-to-sales PS ratio of around 26.5x.
26 times sales for a company essentially holding tokens.
Exactly. That kind of multiple, far above traditional comparable companies, implies investors aren't valuing its current state at all. They are pricing in enormous, exponential future growth based entirely on the potential success of the Worldcoin network. It's a pure bet on the future concept paying off massively.
Which makes the risk profile completely different from MSTR or even BMNR, right? The sources called it binary risk.
Binary is the perfect word. It means the investment likely goes one of two ways. Either it's a home run, a massive success if Worldcoin achieves global scale and acceptance, or it fails completely and the investment goes towards zero. There's not much middle ground.
And what drives that binary outcome? What needs to happen for it to succeed or fail?
Success hinges on several huge ifs. First, the Worldcoin protocol itself needs to achieve truly global mass adoption. Billions of users signing up via iris scans, Second, the tokenomics of WLD need to function as designed, capturing value from this network activity. And third, and this is a huge one, it needs to navigate the massive regulatory and privacy backlash.
The idea of a private company collecting biometric iris data from billions of people,
Yeah, that sounds like a regulatory minefield.
it's immense. Many countries have already expressed deep concerns or launched investigations. Privacy advocates are highly critical. If major governments block it, or if there's significant data breach, or if the ethical concerns just become too overwhelming for public acceptance, the whole project could unravel. That's the downside of the binary bet. And driving the narrative here, the chief storyteller, is their chairman, Dan Ives. He's another well-known face, a very media-savvy tech analyst from Wall Street.
Right. Similar to Tom Lee at BMNR, Ives brings his established credibility and media presence to the role of chief evangelist for ORBS. He's very effective at framing the Worldcoin story.
How does he position it?
He doesn't just talk about it as a crypto token. He frames WLD as essential infrastructure for the future. He calls it the single sign-on for the AI era, suggesting it's the key to navigating an internet filled with bots. He's even quoted saying it's the best utility so far for crypto, trying to position it as something tangible and necessary, not just speculative.
And he put some big numbers on the potential market size, too.
Oh, yeah. He suggests the total addressable market for proof-of-human services could be worth $200 billion to $300 billion. And from that, he derives an implied future value for the WLD token of somewhere between $20 and $30. He draws parallels to the early days of transformative tech like PayPal, painting this picture of exponential growth just around the corner.
So, for an investor, buying ORBS stock is basically the purest public market way to make a highly leveraged bet on that specific vision of an AI-driven future needing biometric identity verification.
That's exactly what it is. A high-risk, high-reward bet on a single, unproven, but potentially transformative concept championed by a very effective storyteller.
Okay, we've covered three distinct flavors of the DAT model. MSTR, the leveraged Bitcoin maximalist, BMNR, the speculative Ethereum narrative play, and ORBS, the binary bet on WorldCoin and AI identity. But the sources also present a compelling alternative path, represented by Jack Dorsey's company, Block, ticker XYZ.
Yes, Block offers a fundamentally different philosophy and strategy, and it really stems from Jack Dorsey's core belief, which he states very clearly: Bitcoin is not crypto, Bitcoin is money.
Bitcoin is not crypto, Bitcoin is money. How does that simple statement reframe their entire corporate approach compared to the DATs?
It shifts everything. If Bitcoin is money, then the goal isn't just to passively hold it as an asset on your balance sheet and hope the price goes up, maybe using financial engineering to acquire more. The goal is to make it useful, to build products and services around its function as a medium of exchange, as actual money people can use.
So Block isn't a fund just holding assets, it's an operating tech company.
Exactly. Block is an operational technology company. They are actively building out a multifaceted ecosystem designed to make Bitcoin easier to use, access, and integrate into everyday financial life. It's about utility, not just treasury management.
And how does that translate into their actual products and services?
You see it clearly in their Cash App integration. They make it super easy to buy, sell, and transfer Bitcoin within the app, sure. But they go further. They have features like letting users automatically convert a portion of their direct deposited paycheck directly into BTC with zero fees.
So embedding it into regular financial flows, making it almost invisible.
Precisely. Reducing friction at the application layer, making it normal for mainstream consumers. But their focus isn't just on the consumer app side. They're also investing heavily in building the underlying tools and infrastructure for Bitcoin itself.
What kind of tools?
This part is really interesting and speaks to Dorsey's decentralization ethos. They're developing open source hardware. One example is the BitKey, which is designed to be a user-friendly hardware wallet for self-custody, making it safer and simpler for average people to actually hold their own Bitcoin, not rely on custodians.
Okay, empowering the user.
And maybe even more strategically important, they're investing in designing new open-source ASIC mining rigs.
The specialized computers that mine Bitcoin. Why open source?
Because the manufacturing of those critical machines has become highly centralized in the hands of just a few large companies. By designing and open sourcing new, efficient miners, Block is directly trying to break that manufacturing bottleneck and promote greater decentralization at the very core of the Bitcoin network security infrastructure. They're building tools to strengthen the network itself.
That is a fundamentally different approach. Building the ecosystem, not just benefiting from the asset price. How does this operational focus translate into their treasury policy? Is it different from MSTR's highly leveraged approach?
Completely different. It's much more measured and directly tied to their actual business operations.
Mm.
Unlike MSTR raising billions through debt and equity specifically to buy Bitcoin based on market premiums, Block has a simple operational policy.
What is it?
They commit to investing 10% of their gross profit, specifically generated from their Bitcoin-related products each month, back into purchasing Bitcoin for their corporate treasury.
Wait, so they only buy Bitcoin for the treasury using profits they actually made from their Bitcoin business activity?
Exactly. It's essentially a dollar-cost averaging DCA strategy funded entirely out of operational cash flow earned from providing Bitcoin services. No massive debt raises tied to market sentiment, no reliance on a stock premium.
That sounds way more conservative
Yeah,
and sustainable.
far more sustainable. It inherently mitigates volatility risk because they're buying consistently regardless of short-term price swings. And it ensures their treasury exposure grows in proportion to their actual business success in the Bitcoin economy, not just based on market speculation or financial engineering.
Okay, this brings us to what feels like the absolute critical distinction between Block and the DAT, something you touched on earlier, the fundamental source of value creation, MSTR, BMNR, ORBS. Their success is overwhelmingly tied to the price appreciation of the asset they hold, amplified by leverage or narrative.
Correct. Their value is derived almost entirely from the asset price, and in MSTR's case, the ability to exploit that price premium through financial engineering.
Block, on the other hand, their success seems tied to actual usage.
Precisely. Block's success relies on people using their products, on scaling their ecosystem. They profit from the growth of the entire Bitcoin economy, from transaction fees on Cash App, from hardware sales like BitKey, from services related to mining or payments. They make money, even if the price of Bitcoin itself is flat for a year, as long as more people are using it through their platform.
So investing in Block isn't just a bet on the price of Bitcoin. It's more like a bet on the gross domestic product, the GDP of the Bitcoin network, the total economic activity happening on it.
That's the perfect analogy. Block is positioned to capture value from the overall economic activity and utility of Bitcoin. MSTR is a leveraged debt purely on the asset's price. This makes Block's model inherently more resilient and diversified. It's built to profit from growth in usage and adoption, which is arguably a more sustainable long-term driver than pure price speculation.
Okay, let's try to bring this all together. We've looked at 4 really distinct companies, 4 strategic archetypes operating in this space. It might be helpful to quickly recap them head-to-head.
Yes, synthesizing is key here. First, you have Strategy Inc., MSTR. That's the leveraged Bitcoin fund. It's a financial vehicle, pure and simple, optimized for acquiring BTC using debt and premium stock issuance.
Got it. Then Bitmine Immersion, BMNR.
That's the speculative narrative vehicle.
Yeah.
A direct copycat of MSTR's structure, but built entirely around the Ethereum supercycle story, despite questionable underlying value accrual. Its valuation seems driven purely by hype.
Okay. Third, Eightco Holdings, ORBS.
That one's best understood as a public venture capital fund. It's a single, high-risk binary bet on a future concept. Proof of human identity via Worldcoin, with enormous potential upside but also existential risks.
And finally, the outlier, Block, XYZ.
Block is the operational tech ecosystem. They're focused on building utility, driving adoption, and profiting from the economic activity, the GDP of the Bitcoin network, not just holding the asset.
The leadership styles also seem incredibly important in driving these different strategies and narratives.
Hugely influential. You've got Michael Saylor at MSTR, the philosophical maximalist. His unwavering conviction is what enables MSTR's single-minded, leveraged focus. Without his force of personality, it's hard to imagine it working.
Then Tom Lee at BMNR.
He's the traditional strategist lending credibility, using his Wall Street reputation to essentially underwrite an extremely speculative narrative for BMNR.
Dan Ives at ORBS.
The media-savvy evangelist, masterful storyteller, crafting the compelling vision of AI identity needed to justify ORBS's VC-like bet on Worldcoin.
And Jack Dorsey at Block.
He's the principled product architect. His focus isn't hype or financial engineering. It's rooted in his belief in Bitcoin as money and his drive to build useful decentralized tools. An investment in any of these is really, in part, a bet on that leader's specific vision and their ability to execute. Now, for anyone listening and thinking about this space, understanding the specific risk profile of each is absolutely critical. They're all high-risk plays, arguably, but they can fail for completely different reasons.
Okay, let's summarize those key risks. For MSTR,
the risk is laser-focused. The collapse of its premium to NAV. The 37% premium fuels the flywheel. If sought ETFs or changing sentiment kill that premium, their core value add and acquisition engine breaks down, it's a financial structure risk.
For BMNR.
The risk is abrupt and catastrophic, narrative failure. Because its valuation is so disconnected from fundamentals and potentially based on flawed logic, like the Layer 2 issue, if the market simply stops believing Tom Lee's story, the stock has no floor. It could evaporate.
And ORBS.
Binary risk. It needs everything to go right. Massive global adoption of Worldcoin and navigating huge regulatory and privacy hurdles related to biometrics. Failure on either front, network adoption or regulatory rejection, likely means the investment becomes nearly worthless. It's concept risk and execution risk combined. Finally, blocks risks.
They seem more normal, like standard tech company risks.
Relatively speaking, yes. Block faces conventional business risks, execution risk, can they build good products?
Yeah.
Competition from other payment companies, crypto exchanges, and obviously they still have a secondary risk from crypto price volatility impacting their operational profits and treasury value. But it's a much more diversified risk profile compared to the others.
Yeah.
It's not solely dependent on one asset price or one narrative holding up.
Okay, so based on this whole analysis, pulling together all the threads from the sources, what are the final takeaways? How should we think about these strategies from an investment perspective?
The sources seem to guide towards a process of elimination first. Given the extreme valuation disconnect and the flawed narrative critique, BMNR appears to carry an unacceptable level of risk. It should likely be excluded from consideration by most rational investors.
Okay, BMNR out. What about ORBS?
ORBS is different. It's not necessarily flawed, just incredibly high risk. It belongs in a different category. It's suitable only for investors with the risk tolerance of a venture capitalist, someone comfortable with the possibility of losing their entire investment on a concept bet. It's not a typical public equity investment.
Fair enough. So that leaves MSTR and Block.
Right, and between those two, the choice depends on your specific goal. If your objective is purely to get established, leveraged exposure to the price of Bitcoin through a publicly traded stock, and you accept the premium risk, then MSTR is the most direct and strategically coherent way to do that. It's the best pure-play leveraged Bitcoin vehicle. But the analysis strongly suggests that Block represents the superior long-term investment model. Why? Because it's more resilient, it's diversified, and it's built on a sustainable foundation of generating actual revenue by driving utility, capturing the network's GDP, rather than relying solely on asset price speculation and the fragile arbitrage of a temporary market inefficiency like the NAV premium.
So Block's model is built to last, potentially through crypto winters and increased competition, because it actually does something beyond just holding the asset.
That's the core argument.
Yeah.
It's a business built on utility and revenue generation, which is fundamentally more robust than a strategy based purely on financial engineering and asset appreciation. Looking back, the digital asset treasury model, especially as pioneered by Strategy Inc., was genuinely brilliant for its time. It cleverly solved a real problem, bridging the gap, providing regulated access for traditional finance into this new world of crypto. That was its genius.
But the ground is shifting under that model now, right? As you said, the ETFs, better regulation, more direct on-ramps.
Exactly. That friction, the inconvenience and regulatory uncertainty that allowed DATs to charge that premium for access, it's rapidly dissolving. Low-cost spot ETFs, clearer regulations, better institutional custody solutions, they are commoditizing access.
Which implies the whole corporate game is changing too. The trend seems to be moving away from just being a passive holder, leveraging up the balance sheet, and more towards active integration, actually using these assets.
I think that's the big takeaway. The next phase of corporate involvement probably won't be defined by who can accumulate the most coins using financial leverage. The winners of the next decade are more likely to be the companies, perhaps like Block, that figure out how to successfully embed digital assets and blockchain technology into real-world commerce, into core financial infrastructure, into new forms of digital identity. It's shifting from passive holding to active building.
So we've really explored 4 distinct corporate visions today, built on very different ideas about what these digital assets fundamentally are. Bitcoin as the ultimate scarce asset, Ethereum as the foundation for a new financial system, and Worldcoin as potential identity infrastructure for the AI age.
MSTR, BMNR, ORBS, and Block each embody one strategic response to those possibilities.
Which leaves us with a final thought for you, the listener. We've seen the maximalist holder using financial engineering, MSTR. We've seen the narrative accumulator betting on huge multiples, BMNR. We've seen the high concept VC bet, ORBS. And we've seen the functional ecosystem builder focused on utility, Block. Which of these corporate strategies, the holder, the narrator, the concept better, or the builder, do you think will ultimately create the most enduring, sustainable value over the next decade?
It's something worth pondering as you watch this fascinating space continue to evolve, likely shifting from arbitrage towards real-world application.
Absolutely. Thank you for joining us for this particularly deep dive today.
Always a pleasure.
We'll see you next time on the deep dive.